have a panel discussion on these challenging issues, investing for a low-carbon economy. And I would like to ask the other members of that panel to enter the stage. Peter Head, Tom R. Fearnley, and Elisabethe Grieg. Peter Head from Arup, Tom Fearnley from the Norwegian Ministry of Finance, Elisabethe Grieg from Grieg International, and also a member of the Sahara Forest Project Advisory Group. Now, to lead this discussion, I'm very pleased to introduce the newly appointed chairman of the Bellona Foundation, Viktor Jakobsen. Viktor has a long and unique experience in investment banking and has been instrumental in financial engineering to steer investments in real renewable energy projects. So, Viktor, please go ahead.
Thank you. Theme: investing for a low carbon economy. And here we have a lot of capital and industrialists. It's investment and return. Thank you for an excellent run through of how things work. And before sort of starting, I will probably start with you, Elisabeth, and go to the left. Bellona has today, in the market of its 25th year, chosen to look forward, focus on the solutions. Because I think most of the people here feel a sense of urgency. We need to do something, and we need to do something now. And usually that means you have to deploy your capital into assets that create solutions. Hence the low carbon economy. How do we decarbonize the economy? What very few people actually are aware of is the fact that investment in solving problems usually comes as a result of necessity more than opportunity. And interestingly enough, as an example, solar is deemed as the future. Well, people, I have news for you, the future is now. The Chinese government has done a couple of things over the past year. Number one, they have warned Chinese industry that they will introduce rationing of electricity in China. What Frederick said in the start, what we used 100 years and 3 generations of doing, Deng Xiaoping actually put forward in 1990, and they're spending probably 3 decades to get to the same level. They need a lot of energy. Because of that, the Chinese government gave 5 Chinese solar PV companies, which have been built based on US pension fund money, German equipment, and a German solar market which have functioned fantastically. They gave them $35 billion in credit lines last year. And that's more than the total historic investment in solar manufacturing equipment from 1978 until today. I've been in the solar industry for more than 20 years. I built a couple of factories myself, so I know the numbers. And it's a big industry. And the marching order, coming back to, you have collective action incentives. China is all about collective action. So we're setting aside $35 billion. And the task we're going to solve is, in the next 2 years, we are going to have solar panels at less than $1. And bringing us back to the California, at that price, you can use less than 0.1% of the California land to reduce imports of electricity into California completely, and it would take you approximately $150 billion. And it can be done in 5 years' time. So that's where we are. So, Elisabeth, both representing family office, representing capital, as well as big industry to the board positions, investing for a low carbon economy. What's your thoughts from either the starter perspective or the family office perspective?
Well, thank you very much, and first of all, happy birthday to Bellona. I think it's amazing what you have been able to do for these 25 years and put yourself on the map, which is extremely important that we have someone like Bellona. To me, it's quite simple. As business leaders and as in a global industry that emits, are responsible for 3% of the CO2 emissions in the world, we need to take our part of the responsibility. And it's easy to say that we can do so little because it's only 3%, but it's 3% and it's important that we show that we take our part of the responsibility. The shipping industry carries about 90% of all transportation of goods in the world. And the ships are already carbon efficient compared to other forms of transportation. But the volumes are so big, and that underlines the need for us to challenge ourselves and take it very seriously. And we also think that as the low carbon economy takes shape, cutting emission will be fundamental business requirement for long-term growth. And stricter international rules and regulations are necessary to move the entire industry in the right direction. But I also think that forward-thinking companies, we are impatient. We cannot wait for the regulators. So increasingly, quality shipping companies are coming up with low-carbon solutions on their own. And we do believe that it is not a burden, it's not a burden to leave a green footprint. We do increasingly believe that it is value creative, long-term, and it's a competitive advantage to take those actions. So in my company and the Grieg Shipping Group, we do put a lot of work and emphasis on developing our ships to meet a vision of zero dangerous emissions to sea and to air. And this is also in line with our overall vision to create lasting values through our carbon efforts. Because we truly do believe that it's more value creative long term to be responsible now. And also a vital part of running a high quality shipping company. So I think I'll just stop there.
Okay. Tom, you're the man behind some of the largest purses on the planet. Very well known today. Being a passive financial investor has its risks because things change. We had a company called Philips, still exists, although in a decimated sense. They have probably the world's largest portfolio of patents within everything, electronics, power, etc. But they lost out in the industrialization of this. And the challenge of having so much money and employing it is to get the adequate return, because it's supposed to be returned and paid to, for instance, me when I retire someday. So, could you give us some insights into the inner circles of assessing this portfolio with regards to the transition from a carbon-driven system to a non-carbon-driven global energy system?
Yes, thanks a lot for inviting me, and again, congratulations to Bellona. It's a pleasure to be here. I'm representing the Norwegian government, I believe, as working on the management of one of the largest funds in the world. I think a few days ago we were suddenly rated as the biggest. When we are the number 1 or number 2 doesn't matter, we are big compared with Norwegian economy. So we have always and increasingly seen the need to have what you call a sustainable strategy. We invest in almost all companies of the world, at least companies of the world. We cannot run away from the environmental risks. Sooner or later they will catch up with us, because we own a little stake in every company in the world. We own 1% of the world stock market, 2% of the European stock market. So we have in our the ministry, which is responsible for the management of the fund, have always taken social responsible investing very seriously. In fact, so seriously that we are seen as an example for most other pension funds of the world. They sometimes copy us. But you may say that we are not doing enough. We are always trying to improve our SRI, social responsible investing profile. And one initiative which 2009 was to investigate exactly the long-term consequences of global warming on international capital markets. We were the first fund in the world to sign up to make an agreement with Mercer Consulting in London, who have exactly the same idea, to investigate, make a thorough investigation into this links between returns, risk, and climate change. So that was, I will just say what our Minister of Finance said when we launched the project in March 2010. He said climate change poses major social, economic, and financial risks worldwide. The Norwegian government takes these risks seriously, also in the management of the government pension fund. The climate scenario study is an important element in our effort to gain a deeper understanding of the robustness and sustainability of our long-term investment strategy. Well, the report was issued in February this year. It was a public report. I recommend all of you to read it. It's a 120-page report with Mercer in the center of the study, but also with 14 other pension funds and sovereign wealth funds from the entire world, actually from 4 continents: Europe, North America, Asia, and Australia. We are very proud at the ministry that we were the pioneers of this project. Our aim was twofold: to put this subject on the radar screen of many large institutional investors, and B, understand for ourselves, is there anything we can do long-term to mitigate these risks and even take opportunity and to steer capital towards this sector. I will not go through the conclusions of the report. I just want to tell you about its existence. There are, however, we are waiting for a tailor-made report for our fund. It will be out in August this year. It will be specifically made for our fund. I also make specific recommendations for all the other 13 funds out there. With $3 million are actually then involved in this study. I think when I talk about big money, we have ourselves, we are representing $600 billion very soon. Other huge funds are participating from pension funds from California, Europe, GIC from Singapore. So it's a lot of capital. And we have had the benefit of working together with very prestigious institutions like the Grantham Institute of Environmental Research in London School of Economics. It's actually headed by Lord Stern himself. And IFC in Washington and other prestigious institutions. So what is the main recommendation of this study so far? The main recommendation is that you should pay very close attention to the risks which are posed by climate change and engage with managers and with the authorities. Both engage with capital markets, with companies, with corporations, and with authorities. Actually, we have been doing that for a while. We have a very ambitious corporate engagement program already, but we can improve that. And we will try to improve it further. And we are engaging with companies worldwide. Our manager, the central bank, Norwegian Bank, has projects or programs to engage with companies, also along environmental and social dimensions. Water management, climate change, children's rights, these are focus areas of our manager. So that is one recommendation. Engage with managers, engage with authorities, and we are actually doing that. But another recommendation is to also try to see if it's possible to allocate more capital towards certain sustainable themes. That means renewables, or what they call sustainable equity. Now this is a difficult business. First of all, because these markets are sometimes rather small. So for a very large institutional investor like us, these markets are not sufficiently developed. So the question is, how can we contribute to develop those further? And we are also working together with, and that's a question which we are actually discussing with other organizations. For instance, the Institutional Investors Group on Climate Change, IIGCC, who is actually working exactly on that subject. How can those capital markets develop so that large investors like pension funds can enter them? Because there is a certain amount of risk. They cannot take too much risk either, pension funds. They have to pay pensions. So you have to, and the conclusion among those studies that we need rules and regulations which are predictable. Forutsigbarhet in Norwegian. And that's a theme which that organization is working, stressing, and we agree with that. Forutsigbarhet is something which can be rules which do not change too frequently. Of course, carbon pricing is a very important tool, and maybe the most important tool.
Thank you. There's a lot of information, and I'd like to have a follow-up question before we enter into the British part of the panel. It goes through actually for both of you, because we have most people have heard about Google, I guess. And Google is, to a certain extent, also to resemble, apart from being a big investor, also a family office run by two entrepreneurs. And a couple of years back, Frederick and myself, we were visiting the green energy czar of Google, Mr. Bill Wheel, and he was given a mandate to allocate $1 billion into renewable energy. Why? Because Google is a massive consumer of electricity, and they have a social consciousness they would like to be. And yesterday, Google announced that they are investing $280 million into a California-based solar PV installer for residentials as part of the bank funding, consumer funding for installing. So it's actually banking with an environmental footprint. Very good way of deploying that capital. And as a follow-up, do you have any concrete actions in order to get out of the indexed stock investment theme into a more focused allocating your capital directly to a carbon negative or carbon low future?
Well, you're right that we are currently mostly a passive investor, although we have an active management program, but we are close to being a passive investor. So it means that we are investing according to the market size of the market. So if a market is small, if a sustainable equity theme is small, we will not then invest too much in that class. But we also have an active management program where we launched 1 year ago an environmental investment program, which has been implemented by our manager, the Norges Bank, Central Bank. And we asked them to develop a green sub-portfolio along our guidelines, and that actually happened much faster than we thought it was possible. It actually it has grown to 25 billion Norwegian kroner quickly. So that is one very concrete step we have taken, and our manager has taken that job very seriously, and they have even a team working exactly on that. We can probably
I think I have to stop you there because we're approaching but Elisabethe, you have a very short comment.
Yes, we can make it very short. And, but I think there has been some big numbers around here from the government. I think, to me, it's as simple as that we can all do something. And as a middle-sized industrial group, to us it's extremely important to have more than one thought in our mind at the same time and develop our industries where we are. But we do see it as a great opportunity to enter into the low-carbon future. So we are invested in, or we are building up these days a wind offshore company. We believe that short-term, medium-term wind is going to be important, especially offshore. And it's a long-term investment, and it's a family business that is approaching 130 years. We do take a long-term view on what we do, so we do believe that, as Mr. Cameron was mentioning earlier, to us that's important, and we do believe that this is the future, so we want to be part of it.
Peter, I'll let you wait for 15 minutes. What's your take on investing for a low carbon economy?
Well, basically where I work is not just the UK, actually globally, in the space between all these wonderful ideas that we've heard about integrated systems and between investors looking to invest. But the area we haven't talked about today is planning and integrated resource systems planning for sustainable development in regions and cities and communities. And that's the area I work in. And I think this is an area that Lord Prescott led in the UK. He created an environment that created a connection between national government's sustainable development objectives and local needs in terms of project delivery. And what we have discovered in that, working all over the world in eco-cities in China and London Olympics delivery and so on, is that what this transition means for businesses is a move from selling stuff to selling bits and pieces of stuff to selling services. But essentially what we're talking about here is going from using non-renewable resources wastefully and polluting the planet to using renewable systems in closed loops in the way that's been described. And what happens in the business model there is that you start to move towards value services. So instead of selling land, you look at land as its ability to provide service to the community in the city. And as soon as you do that, you separate land and water and energy from buildings, and you begin to develop models for doing that. So I think we understand that. When I've talked to any business in the world, they're beginning to see that you've got to change the business model in order to get the capital to get a return. It isn't the old business model. So there's a changing business model that I think we can understand. But the problem is that we're not putting enough money into the planning area in this space. There is a paucity of money to go up front to get projects fashioned, to get communities involved, and to get to financial close with all the clever financial capabilities in order for the capital to flow. And that space I've been intensely frustrated in for the last 6 years. So I've now created a charity to actually create the tools and to create a capital flow into demonstrations in this area, because you can't do it through traditional finance. Getting the finance before the financial deal is on the table to fashion these things is terribly difficult.
Is this because of lack of vision among the people who are responsible?
Yes, well, it's not a lack of vision very often. I mean, even in London we had Ken Livingstone, who was a visionary leader in London, but fashioning the deals within the London community, even with the city leadership, is a very complex and difficult thing to connect these things up and create a convincing investment case for water, energy, waste, transport systems within it. And that requires a lot of intense design and effort with integrated resource models and so on. And we're not putting the money into it. And I think I go to so many meetings where this is never discussed. But actually it's all about capital and technology and capital, and it's a missing bit. So,
being a sort of a normal citizen and taxpayer,
yeah.
I guess I have the private expectation that the people we have placed in charge of administrating our cities and communities actually takes care of this.
They do take care of it, but we don't have the skills and the capability to deliver these complex integrated systems and understanding actually the economics of it in relation to the city. We've got to articulate the economic benefits to the city and the financial return for the investors in a comprehensive package. And that requires a different set of tools and models. And so I'm actually now trying to create those and actually make them available open source to every city and community in the world, so they can then start doing this, because I think we're missing that bit.
Let's touch on what you said, James, about collective action incentives.
Yeah, I actually think this is a really good idea. I was yesterday with the Olympic Delivery Authority in London, and that is a good example, I think, of sufficient investment in the organisation of the investment that follows.
Yeah, the reason that they had enough money because they had the incentive to deliver it on time with a set of commitments to the IOC.
So I think there's a lot in this. There's a lot in this. I think we could organise a lot of implementation of public policy commitments on the environment this way. It'd be helpful. But let me make a couple of observations about what you've heard about the finance too. Number one, if you continue to invest in an index that is heavily weighted in carbon, you're increasing risk, not decreasing risk. And you're increasing risk over the longer term. Your beneficiaries are going to lose as a result of that. And we are horrendously dependent upon a few fossil fuel businesses for our dividend yields. Now, even if you care about climate change, and you had no interest whatsoever in resource efficiency, it's not a good system, it's not a good ecological system that's dependent upon a few species for survival. And if your dividends, and it's a frighteningly large percentage of any index, the British index is one example, the Australian is an even more extreme one, they are heavily concentrated in fossil fuel bearing stocks, and the pension liabilities over the longer term are therefore dependent upon the continuing yields of those stocks, and that is not a safe system for long-term capital deployment, in my view. The second thing is that we exaggerate the risk of the alternatives. We describe the technology risk and the alternatives as if it were impossible to overcome. We find 100 reasons why we can't invest in businesses that are too small. Of course they're too small, the incumbents are very large. You have to create space for the small businesses to get large, to consolidate, and that requires policy making and is designed to encourage innovation. And it doesn't always exist. And the incumbents fight hard. They've got good resources to keep out competition and do it very cleverly. So the other thing that's obvious for a fossil fuel-based economy is that investing in fuel efficiency and in the alternatives is the most natural and largest hedge you could ever imagine. Because you prolong your market, you get more out of your fossil fuels, so you have a longer market lifespan, and as you extract higher rents from higher prices, you can deploy them in the alternatives, and so you have a more secure future. So it's absolutely obvious to me that every sovereign wealth fund in the world, they all seem to be based on fossil fuel resources, or at least commodities that are in the fossil fuel or related to energy. They should all be allocating significant percentages away from carbon towards the alternatives. And when that happens, people can bid into that new capital marketplace with their ideas, whether they're small businesses or large, and there are incentives for management to move as well. So the senior management in the fossil fuel industry think, you know what, there's a career opportunity for me to do something different. The people who want to beat the backside of their businesses, because they've got an alternative, feel that they can raise capital in order to take them on. Consolidation can happen. The smaller businesses can get together and become bigger businesses, because they know that there's a capital source. And right now, I'm telling you, it doesn't exist. And the allocations that you have made are terrific, but they're tiny by comparison to the rest. And it shouldn't just be listed equities. The bulk of the market in the last few years has got frightened. It's hardly doing anything. All the institutional investors are sitting on their hands. Private equity is not being invested in anything like the same amounts. It means there's less money for innovation. And we really are in a quandary. We've got to find a way of delivering that report. Obviously, there's some serious work going on here in Norway to do. But we've got to find a way of sensibly, thoughtfully allocating away from climate risk towards opportunity. We've got to do it like tomorrow.
I'll start with Peter and Elisabethe.
Could I just say something about the value proposition for those investments? Because what we found is this integrated system of thinking that James also complemented earlier. We found the value propositions can increase by 2, 3, 4 times. We're not talking about 10% change in value. Once you have a connected series of investments, then actually the value you get is much leverage much more. So actually, I think it shouldn't be looked at as single investments into technology. It should be looked at as systems, appropriate investment, getting behind a complete system that will actually deliver real good.
We're starting to get an interesting panel debate here, I think. Yeah. Because, just a small remark before I'll let you in, Elisabethe. What you said about the lack of investment opportunities is rather interesting. If you look at, for instance, the solar industry, very few people are aware of this. It runs at the annual run rate of $50 billion a year. And I think that that's, call it, annual investment level for the next, let's say, 100 years. So it's a rather interesting market to be exposed in, and most of those 50 billion are yield plays, long-term contracts, etc. But until now, it seems like Ackermann and Deutsche Bank and the German banks have sort of kept this market for themselves. Elisabethe.
Yeah, since I'm here more as a representative of an industry, more than and not an investor, and more like an active owner, I see it from a bit different perspective, and I don't find myself agreeing with you that nothing is being done, or very little is being done, and there are no incentives, because at least in the shipping industry there's a lot of energy put into the development of new low-carbon solutions, and we see how quality companies cooperate, because we do see that we cannot solve this by our own, each company by its own, but we have to go together. We cannot wait for the regulators because they are too slow, and the global to get a global system, it takes a long time. So someone has to be in front. And I find that that energy is really paying off in good new solutions, and we see that we have the new ships that is coming in now or being delivered these days are 15, 20, 25% less emissions than only 10 years ago. And it's a rapid development, and it's really interesting to be part of, and to see that in industry and other industries as well are taking this extremely seriously, and are doing at least as much as we can in order to get to our goal of zero emissions. So I think it's important that we don't lose faith, and that we believe in what we are doing. But in the end of the day, and I think that is one of the problems and challenges, is that yes, we can be long-term. We are a private company, we can be long-term, we have solid equity. But long-term, we also need to make money. Because if not, if we don't make money, then we lose out. And then some others that did not take the responsibility might, and do not work as hard as others, will win out in the competition. So it's really two things at the same time. You have to work hard in getting there, but you also have to make it as a business.
I agree with you that quite a bit is being done already. But to the point of James, I think that it's a question about who does what first. You just mentioned a few moments ago that if there's a universal price of carbon, investors will come and they will allocate big time. I agree with that. And actually, but until there is an agreement, in fact, that will not happen. And I'm not talking about our fund. I have been speaking with pension funds which have daily or monthly liabilities.
For you, especially long-term yields. And there really isn't a good enough reason not to, except the fact that you still get better yields in many instances out of the fossil fuel industry. So that's what skews the debate. It's not there are no returns in the alternatives. The returns are actually fine, and the risks are grossly exaggerated in many of these areas. But by comparison to what is done normally, they don't look as attractive. And that depends, again, on getting the technologies up to scale. Then, of course, I think you can deploy large amounts of capital in big infrastructure or in a company that's big enough to take your equity.
I think we're about to round up, but back to my sort of introduction, investing in decarbonizing the economy based on necessity or opportunity. If you look to China, they're doing it from necessity. And it seems that we will be, based on Frederick's question in the introduction, we have developed our welfare based on consuming large amounts of dinosaur bones, as someone would say. And right now it seems like China is deploying the capital to solve the issue. And we're sort of slightly being left behind talking. So what does it take to walk to watch? Elisabethe, short brief, and then we'll go
the challenge is to see where is philanthropic, where is a project, a philanthropic project, and when does it become a business? Because when it's too long term before you see a return, then in a way it gets more like philanthropic, and it gets something that you do because you strongly believe that it needs to be done, but you don't expect the type of return that you would do if you invest just to get your return on your money. So I think that it's important to be able to find that balance between enough philanthropic money and developing it into a business.
Thank you. Tom?
Yeah, there are two things which are needed. I think long-term investors, well, like us actually, which has who escapes this short-termism, which is a problem in many market. And just to refer to an interesting paper by World Economic Forum recently called Investing for the Long Run, where they point out the need for more long-term investors. For example, to invest in climate technology and environmental solutions. So that was one point, long-term investors. And what was my second point? Right, I think that was my main.
Okay, thank you.
I'm going to find myself making a counterpoint, because actually what is going on in China is not delivering a low carbon outcome, it's delivering a high carbon outcome. The proportion of renewables is not going to be more than 10 or 15%, and coal-fired power stations are accelerating in their construction. So actually it's simply a scale thing. The China market is so big that the scale of investment in renewables and clean tech is very big, but it's actually not delivering a low carbon society. And so that, for me, is the answer to your question. But actually, within the basket of total investment, it's tiny, as James has told you. Still most of the investment's going into high carbon stuff. So actually, I don't think it's an example of an answer to the question. And it makes an even scarier view of the whole situation. There isn't an example anywhere where it's happening.
I think you can bring necessity and opportunity together. I think you'll find near-term investments that produce good returns that will last in energy efficiency, in buildings, in industrial plant. I think you'll find long-term dividend yields that match perfectly with pension funds' long-term liabilities. In infrastructure that is done in an intelligent way, i.e. in a resource-efficient way, and that you could call that green, but I'll be happy with resource efficient. And those investments are available at scale today, and very large amounts of money can be deployed for a big pension fund to do that. I think you can incentivize innovation across your economy without particularly picking out clean technology, but you can work with those who are developing the ideas that will revolutionize the way we run our economy and provide incentives specifically for them in IP patent boxes, in tax-free regimes for R&D investing and the like. And if you put those things together, and you create a culture of opportunity in this transformation. So it is a little bit scary, but it's also a lot exciting. Then I think we will get the innovation that we're required to transform our economy. But we need very large amounts of capital to do that, and we have that